When we think about returning capital in a capital-intensive business, we've got to be really super careful about, how much capital does the business throw off? What's the, in terms of our capital allocation strategy, what's the best way to generate returns for shareholders? And that's always going to be a balancing act. It's going to be around growth, so whether that's growth through the drill bit or growth through the acquisition of additional acreage, but also it's about returning capital to shareholders. We feel like the buyback is the most effective way of doing that, particularly when our shares are trading, below what we feel like is a reasonable valuation. The opportunity for us to buy back shares, reduce the share count, effectively means that shareholders that are with us for the long term own a bigger piece of the company, and that's ultimately what we're trying to achieve. If we think about, that getting that balance right, so it's how much capital should we be diverting towards growth initiatives, how much should we be diverting towards production. So, in this environment, keeping production stable rather than rolling out, big drilling programs into, and depleting our inventory in a lower pricing environment. So that then enables us to have some capital available to execute buybacks. So that's kind of the framework that we use for deciding when's the appropriate time to execute the buyback as part of our DNA. It's something that we'd like to be doing all the time. There'll be periods of time when we're deploying a lot of capital where maybe that's not possible, but generally speaking, we'd like to be able to do it all the time.